Hello, Mr. Piland's economics students. This is the video where I explain a little bit of monetary policy to you. Let's get started on it and we'll explain it as we go. Just remember that when we learn about fiscal policy, monetary policy is another policy by which the US government tries to control the money supply of the United States of America. They do this in response of two basic things: the economy going too fast or the economy going too slow or decreasing. So they try to get the economy moving again or slow it down based on what they are seeing. The goals of monetary policy are to have stable prices, full employment of individuals in the United States, and sustainable growth over time. These are the goals. So they're constantly looking at the same things that fiscal policy looks at. The only difference is that monetary policy is controlled by a different body within the government. Monetary policy, and up here, by the way, is a link to a really nice video that kind of explains it all in a nutshell. I've added this video to the PowerPoint. Please feel free to look at the video. Actually, I strongly recommend you look at the video. It gives you a little bit better understanding of what's going on. The expansion or contraction of the money supply in order to influence the cost and the availability of credit. This is controlled by the Federal Reserve, which is the bank of the banks. People do their banking at a bank. Banks have to actually borrow money from a bigger bank, which is called the Federal Reserve. The Federal Reserve also has the ability to print money and control the interest rates by which people and other banks borrow money. So by raising and lowering that interest rate, they can either influence people to borrow money or they can influence people to save money, invest money. And that either speeds up the economy or slows it down, depending on what they're seeing. Monetary policy is controlled by the Federal Reserve, the bank of the banks. For anybody who's really into Game of Thrones like I am, it's the Iron Bank, where all of the countries have to go to borrow their money to go to war and things like that. Anywho, so next, the Federal Reserve system structure is you don't necessarily need to know it, but the way it works is fairly simple. Obviously, the inner workings of it are much more complicated. It has a board of governors that meet. It's got 12 reserve banks throughout the United States of America. So the Federal Reserve is not just one bank. It's got branches out there, but only 12 of them, so it's not a whole lot. And then it's got the Federal Open Market Committee. This is a committee of people that are on the boards and people who are in charge of making decisions about what to do with their power. I said that the Federal Reserve has the ability to raise and lower interest rates. It also has a couple tools that it can use to either stimulate the economy or stall the economy. The Federal Open Market Committee is the committee that meets and actually makes this decision to do it. And they meet, I think it's 8 times a year to discuss this stuff, and they make decisions then. Sometimes they don't make a decision. Sometimes they do, depending on how the economy is doing. All right, so where are the structure located? We've got most of the banks are east of the Mississippi River. You got Chicago's got one, Cleveland, and of course, they're usually in big cities. And then you got Atlanta, Dallas, St. Louis, Kansas City, and then you have got San Francisco all the way across the West Coast of these Federal Reserve banks. They do this, obviously, just like Bank of America has branches in your hometown. They do this to make themselves more accessible to banks. They have branches, so you can actually get to them. Now, let's get to the Federal Open Market Committee. The Federal Open Market Committee is that committee that meets. It's members of the reserve banks as well as other high-ranking officials. They meet and they set policy. As a matter of fact, they set monetary policy. Remember, the United States government in the form of Congress, the Senate and the House of Representatives control fiscal policy, taxing and spending of the government. The monetary policy is controlled by the Federal Reserve. This controls interest rates to make it easier or harder for people to borrow money from a bank. This announces, so the Federal Open Market Committee will come out and announce the federal funds rate, which is the baseline interest rate for the entire country. So the federal funds rate will be here, right? And then so what a bank does is it charges its customers to borrow money from it a little bit higher than the federal funds rate. So as the federal fund rate goes up, banking interest rates go up as well. And so it makes it harder for people to borrow money when interest rates are high. If they find out that people are not borrowing money and the country is slowing down financially, what you're going to see is the open market committee will decide to lower interest rates. And then as they lower the federal funds rate, banking interest rates will also lower as well, making it easier for people to borrow money. And of course, when people borrow money, they tend to spend it. And since one person's spending is another person's income, that stimulates the economy. If the economy is going too fast, seeing too much inflation, prices are going up, you're going to see that interest rate go up. Federal funds rate starts to go up to make it harder for banks to borrow money. Then the banks are going to take their interest rates that use to borrow money from them, and they're going to tick it up even higher than that. As those interest rates go up, people are going to stop borrowing money. Why? Because the higher the interest rate, the more money you have to pay back on a loan. It makes it harder to pay back a loan. If people stop borrowing money from a bank, they stop spending money. And since one person's spending is another person's income, they will stop spending it in the economy. People stop making as much money, and the economy will slow down, which is the whole point of raising interest rates. So the federal funds rate is a very key feature of our economy. It is a major macroeconomic indicator that will tell you how successful our economy is right now. So let's actually figure that one out. What are we going to see here? What do you think? Oh boy. Here's what you're going to notice right now. This is 2004, right here. This started this huge incline in the federal funds rate. In other words, from 2004 to 2007, the United States of America was basically saying to investors, to people borrowing money, stop borrowing money. They were hiking the interest rates up, hiking the interest rates up, hiking the interest rates up to get people to slow down because they were seeing too much activity in the economy. It was a little scary. What do you think all that activity was? If you guessed that people were buying a lot of homes with borrowed money, you are absolutely right. People were purchasing homes at an amazingly high rate because the prices of homes were going up so high, people thought that they could make a really good investment in homes. Well, what happens? You see it right here. The financial crash of 2008. Everybody found out that these homes that they were making, they really weren't worth all that much money. And so when home prices went down, millions of people in America lost their jobs and could not stimulate the economy. So what does the federal government do? They actually, not the federal government, excuse me. Right after that, you see the Open Market Committee of the Federal Reserve, they lower interest rates. I'm sorry, I keep flipping pages. I don't mean to. They lowered interest rates all the way to almost zero. The federal funds rate became zero. In other words, is this a good sign or a bad sign for our economy when the interest rates go to zero? If you guessed it's a bad sign, you're absolutely right. In other words, they are trying to convince people to go to your bank, borrow money, and make a purchase. Please buy a car. Please buy a new home. Please stimulate this economy. We need you to borrow money from the bank, spend it on the economy, and get this economy moving again. As you can see, from 2009 all the way to 2016, 7 years, that interest rate stayed at zero. The reason was because the economy wasn't picking up and running again. We had some signs that the economy was performing better. Stock market started to come back a little bit. People started to buy some homes here and there, but it really wasn't accelerating the way that the the Federal Reserve would have liked it to. Now, here's what you start to see in 2016. Look at the trend. Every few months, the Federal Open Market Committee was meeting saying, okay, let's increase the interest rates, increase the interest rates, increase the interest rates up and up. In other words, they are saying that the economy is getting healthier and healthier, so they can afford to increase the interest rates a little bit. And now, what do you see? 2019 and 2020, the interest rates have once again fallen off of a cliff and gone down. Why? Because you guessed it. We just had the coronavirus outbreak and people are losing their jobs and there is less economic activity. So this is the way the Open Market Committee reacts. It says, okay, we need people to borrow money and we need people to spend it on the economy to keep this economy alive. So let's lower the interest rates, make it easier for people to borrow money, and hopefully that will stimulate the economy once again, especially when this stay in place order is over. Hopefully you can get a good deal on a house or a good deal on a new car, because that's what it takes to stimulate the economy. Purchasing things, buying things, demand needs to increase from everybody. We'll see if this works out or not. Okay, the three things that the Federal Reserve can do within their power is, one, they can influence rates, like we just talked about. The federal funds rate, it's also called the target rate. They also have something called the discount rate. All of these rates are very similar in the way they act. If a bank wants to borrow money from another bank or borrow money from the Federal Reserve, they have to borrow it at their rate, the Federal Reserve rate, which is called the federal funds rate or the discount rate. And then that rate is the base level rate. Then the bank who borrows money at this rate needs to loan that money out to people in their towns at this rate. They always have a little bit higher rate for the people that are banking at the bank than the rate that they pay for the federal funds. Banks have to keep money in their bank at all times. So therefore, sometimes they need to borrow it in order to have it there, because the way the bank makes money is it takes the money you save in the bank that you give the bank and it loans it out to other people for their business ventures or buying a new car, and it charges them interest in return and gets more of that money back. The other thing that the second thing that the Federal Reserve can do is it can change the reserve requirements of banks. After the stock market crash of 1929, the Federal Reserve and the nation and the United States realized that one of the problems that was having is that people were making runs on banks. In other words, people in the United States weren't trusting the banks to save their money properly. So what they would do is they would line up at the bank, they'd go into the bank and say, I want all my money out. And they were called runs on banks because people were panicking. So then all of a sudden you'd get 3 or 4 or 5 people into the bank, 20, 30, 40, 50 people into the bank. And all of a sudden the bank would go, sorry, we're completely out of cash. We have no cash. You took it all. You took it out of the bank. And so the people that had their money in the bank lost it because the bank didn't have anything and there was no way to get it back. So what the United States started doing is insuring the money that was in the banks, but also telling the banks, hey, you have to have a certain percentage of money at the bank or available to customers at all times. You need to be able to have that available. And that's called a requirement, a reserve requirement, so that if something does happen, like 7 or 8 customers come in very quickly and say, I want all my money, you have to be able to give them that money. And you also have to be able to have money that you need on hand. So let's say that reserve requirement is 25%. That means the bank can only loan out 75% of the money that it has in the bank. If they lower that requirement, in other words, 15% of the money needs to stay in the bank, then the bank can actually loan out 85% of the money in their bank, which increases the amount of money in circulation, which stimulates the economy, hopefully increasing the economy. So people get more money out of the bank, they spend it, and since one person's spending is another person's income, the economy gets stimulated and it gets back on track. If they see too much upswing in the economy, too much inflation in the economy, well, then they can actually raise the reserve requirement, take it up to like 35%, which means the bank has to keep 35% of their money in the bank and can only lend out 65%, which reduces the amount of money in the environment, which decreases people's demand, and that makes the aggregate demand of people go down, which controls the economy and starts sending it in the opposite direction. Hopefully it does the same thing. So it can do that. It can make banks hold on to a lot of money or a little bit of money. It can change that reserve requirement. Last but not least, the tools of the Fed, this is the most important one, the one they do most often, is they actually engage in open market operations. They actually buy or sell bonds to to banks in the open market. So in other words, they can either give the banks more money to lend out. How do they do that? Well, they buy bonds from banks. The banks give them a bond, they pay the bank money in the form of cash, and then the bank has more cash to lend out to people, which stimulates the economy. Or they can do the opposite. If the economy is going too fast and it's getting dangerous, they can actually, they can sell bonds to the bank at a certain percentage rate. They sell the bonds, the bank pays the Fed cash. That takes money out of the bank. And that, therefore, the bank has less money to loan to the people that go to that bank. Less money in the economy means the economy will slow down. So those are open market operations. I've included here a video on open market operations that really explains it very well. I suggest you look at the video because the video also has a really good way of explaining it with pictures that make it very clear, or at least more clear than I can with my hands, as to what goes on there. These three tools of the Federal Reserve you need to know. And boom. Okay, so that's it for it. Obviously, there's a lot more that goes into this. I really encourage you to watch the videos I'm adding to the agenda and the videos that are in this this PowerPoint presentation, because it gives you a clearer idea of what goes on. But just remember, the Federal Reserve acts like their monetary policy acts like fiscal policy. If they see that the economy is going too fast and its inflation is going up, that is scary. So they use their tools, the rates, the requirements, and open market operations to slow the economy down, because too fast is too fast, and you don't want that. If they see that the economy is struggling, they use their tools, rates, requirements, and operations to try to speed the economy up again, get people buying stuff, get money into the environment, so they can control the amount of money that banks have to loan to people, and they can control how easy it is to loan the money to people on the streets. That's what I got for you. Tools of the Fed, monetary policy. Mr. Piland, hit up those office hours if you need any extra info. Talk to you soon. Bye.